Just remind ourselves of where we are. We are still doing leg 4. We have a 3, 4A, 4B, 4C. We perceive that this 4 is finished, then we're going to be breaking out into dot 5 to complete high degree 3. Tomorrow is a day for bullish gold, probably, because if we get poor employment, it means poor economic activity in the US, higher gold. So, most likely that our holding goals is going to pay off handsomely tomorrow. I know we have been holding gold for some time, and that we usually get retractions and we have to hedge against the retractions and take profits, small, very small profits on the hedges, and still hold the gold and then hedge again if the market breaks to the downside, take small profits on the hedges. Costs money because holding gold does not pay interest but actually pay finance fees. So probably the hedges may make up for some of the costs, maybe not, but in reality, break to the upside is going to be very, very lucrative and uh, rewards any expenses that have been spent. Unless you're short-term trading gold, it's a different matter. All right, we don't usually short-term trade it here. All right, so the bounce comes in. We're looking at a delayed 45 minutes of the current market actions at dot 1, 2, dot 3, 4A, 4B, maybe 4C, maybe dot 3, dot 4, 5. Rounded up high degree 3, high degree 4, and A, B, and a C. Market was moving up higher 2 days ago. We'll get to look at the internal segregation, but we just want to make sure that the bounce comes in at 50% and between 50% and 38.2%. So it's still bullish. Take a look now at the developments in the bounce. We had a trigger. Trigger took us all the way to the neckline. At that point, I believe we have seen a leg 3. So remember, we're doing a higher degree 5. So we have a dot 5 here, we have a 3, we have a 4, we're going to get a 5. 5 swings must have internally, each one of the 5 swings must have smaller internal 5 swings. So let's do the labels on the 45 minutes. We have a 1 and a 2, we have a dot 1 and a dot 2, where you have that indentation. We have a 3 and a 4, where you have almost the same indentation as a leg 2. Would look like either we have a 5 or we don't have a 5. Either case, we got the bounce out of a dot 1. We're expecting the maximum is high degree 1. But we got the bounce out of a dot 1. Dot 1 is the smaller level 1, which means the market is still doing a 5 because the indentions here are very close to one another. Actually, indention 4 is higher than indention 2. So the market is still doing a 5. After 5, you get a higher degree 1, and then probably you get an A, B, and a C. You get the C shoulders, and the market moves higher. This is conditioned that tomorrow the employment number is not very bad, is not very dismal. So if the employment number is around 140,000, for example, gold will go nowhere. It will not go to the downside. It will, of course, reverberate, but we'll just do shoulders. Maybe it goes to the downside. I again attack 2,880, 875, showing here, because it would have done a 5 and you have a complete 5-wave swing. You attack level 1 or high degree level 1. That 3, 4 can take you with the 5 dots, dot 1, dot 2, dot 3, dot 4, dot 5. High degree 4 in white can take you to 2,875. Conditional, of course, that we have a surprisingly good employment number. That employment comes in at 200,000, 250,000, that can happen. Assuming we get poor employment, assuming we get what to expect, what we already expect, 140,000, I believe there will be no volatility. We just stick with 2,100 levels. If we get poor employment, this is where really opportunity is. If we get poor employment, we break the old market high, 2,950 at least. So we look at projected targets on the hourly. But if we have poor employment, we are going to attempt to break the market high. Probably, if it's very poor employment, we will support above 2,950 and continue higher. All right, so we take this live, check for triggers on the smaller frames. Most participants, I believe, are discounting bad employment numbers and so expected to break higher. We want to check momentum. We appear to have a bounce on the 1 hour. This is a very important bounce because it's slightly above internal level 2. On the 2 hours, we're doing a level 1. This is called level 1. I mean, you have 5 swings here, 1 and 2, 3, 4 and 5, A, B, and C. This can become a motive wave that will take the market higher, take it to 4. Same level 1, take it to 45. Level 1 again. 30. Some negative momentum, 15. Fundamentals, of course, are for higher gold because of the possibility that we're going to be seeing weaker employment. I'm looking at the motive wave that should drive the market higher. It's a shoulder level. Current market appears supported at 61.8. We're doing a wedge. All right, so we believe this is going to resolve to the upside. It's highly unlikely that we really have a good number, but if we did get a good number, we can still, of course, fall to 38.2. And the wedge would simply continue to the downside and bounce a level 1 instead of bouncing the vicinity of a level 3. But I believe we get a good number. We should be already long. We have the longs. I believe they're safe. We're going to be looking at the target projections. If you wish to do longs, we can still consider doing an AB 1, 2, 3, 4. We can still get maybe 2,890, 50%. I doubt we get lower, but we really can get 2,000 because this appears corrective, and this is a 3, it's a 4, it's still a 5. So the best entry is 2,890. If you find that you're in good money at this, or any money at this point, you can close out and do an entry at 2,890. We can have a buy stop above the market high because it's not 2,930. It is not definite that we're going to get 2,890. We're seeing, of course, 2,882, so we should even get 2,885. I would go to close what we're holding unless makes little difference and re-enter 2,885. Have a buy stop at 2,930. Hedge for that buy stop at 2,930 is just below the head at 2,900, should be fine. If we do the entry at, if we are fortunate to be able to get an entry at 2,885, we hedge 2,860, $25 lower, or 2,865. Then let's take it to targets. We're just saying we have a buy stop at 2,930. Yes, sir, we do, because this is resistance 1. We're also supporting the moving average. This is very important here. It's good that we have been able to check on the hourly. We're supporting, yes, we were supporting the moving average, failed earlier, but we seem to have done it weaker, and we're back above the moving average. Any trend must be above the 200-point moving average. So this is confirmation that this is still trending. Resistance to 3,005. We will attempt to go to 3,005 tomorrow, 3,000, on perception that we're going to get full employment. All right, so to recap, we hold longs if we have them. We can have the hedge this time at 2,895 or 2,000, yes, 890. Using a bigger chart, of course, rounds up all of the candle structures. So if I am long, I will just have the hedge at 2,885. Hold the long all the way to 3,000. It's better than closing and then having to buy higher. That's my take on it, but I could be mistaken. But if you see good money, it's perfectly all right. You can close because there's still negative momentum on the 15 minutes and we can still move a bit lower. So if we move lower, we get to test 2,885. We can do the entry there with the hedge at 2,860. Again, hold it to 3,000. If you wish to hold the retreat, I think it's perfectly all right. Take it to 3,000 and just have the hedge at 2,890. If you wish to do a market entry, it's better to attempt 2,900. All right, if it doesn't make much difference. Market looks supported at the 200-point moving average, so we just take the entry. Market entry is also fine. Target 3,000, 3,005 is showing here.